OG, John AG here. Silver is falling as I record this. We're currently trading around $78 per ounce, down from yesterday's close of $81.88. That's a 4.7% drop in a single session. And while everyone is watching the price fall, something critical just happened that almost nobody is talking about. COMEX registered silver inventory has just crossed below 100 million ounces for the first time since the supply crisis began. We are now 16 days away from March 27th, the first notice day for March deliveries, and the trap is being set. Before we get into the data, if you've been following this channel, you already know we don't do hype, we don't do fear, we do numbers. And today, the numbers are telling a very specific story. If this analysis helps you understand what's really happening, hit subscribe and drop a comment with OG John AG. About 75% of viewers still aren't subscribed, and that engagement keeps this content going. Now let's dive in. Current price action. Silver is trading at $78 per ounce as of midday, February 11th. Down 4.7% from yesterday's 81.88s. Down 35.5% from the January 29 all-time high of $121. Still up 22% from the February 5 crash low of $63.90, and up 144% year over year. This kind of volatility isn't unusual. This is silver. The real question isn't why the price is falling. The question is what's happening underneath the price that most people can't see. And what's happening is the setup for March 27. Gold is trading around $5,030 per ounce. The gold to silver ratio has widened to 64.5 to 1. At the January peak, that ratio was 30 to 1. Every time this ratio widens, it creates mathematical tension. If gold stays at $5,000 and the ratio compresses to 50 to 1, silver trades at $100 per ounce. That's the math. Bitcoin is around $69,900, down 3.1% today. I've said this before. Below $65,000, risk assets struggle. Above $75,000, markets stabilize. Right now, we're in the danger zone. Bitcoin is leading, silver is following, the correlation remains intact. What just happened at COMEX? Here's what almost nobody is reporting. COMEX registered silver inventory just dropped below 100 million ounces. Depending on the source and timing, we're sitting around 100 to 103 million ounces. But psychologically and structurally, we've crossed the 100 million threshold. For context, October 2025, 167.7 million ounces. Today, about 100 million ounces. That's a 40% decline in 4 months. The current drainage rate is roughly 785,000 ounces per day. If that continues for the next 16 days, we'll enter the March delivery window with only 87 to 90 million ounces of registered inventory. Now look at the obligations. The March contract has open interest representing 425 to 455 million ounces of theoretical delivery. That's a 4-to-1 mismatch. Normally, only 2% to 5% of open interest stands for delivery. That would be 8.5 to 22 million ounces, which COMEX could handle. But these are not normal times. February deliveries are running at a 98% delivery rate. Let that sink in. 98% of open interest is demanding physical metal. That's 18.72 million ounces delivered out of 19.11 million ounces of open interest. This is no longer a speculative futures market. It's becoming a physical allocation mechanism. If March follows February's pattern, we could see 200 to 300 million ounces demanded against less than 100 million ounces available. The math simply doesn't work. The trap being set. So why is silver falling if a delivery crisis is coming? Because that's how traps work. When silver was at $121, everyone was bullish. Retail piled in. Margin traders were fully leveraged. Speculators were euphoric. That's not when squeezes happen. Squeezes happen when sentiment is bearish. Weak hands have been flushed. Traders think the rally is over. That's where we are now. 6 consecutive margin hikes forced liquidations. A hawkish Fed narrative shook confidence. Chinese speculators unwound before Lunar New Year. These are technical factors, not supply and demand fundamentals. But while price falls, look at what institutions are doing. SLV saw a 1,023-ton inflow in a single day. That's 32.9 million ounces, the third largest daily inflow in its history. PSLV has added 10 million ounces since November, doubled its equity program to $2 billion institutions. Don't buy when prices are rising and everyone's excited. They buy when prices are falling and sentiment is weak. That's what's happening now. The Shanghai signal. Here's another critical piece. While Western paper prices are falling, the Shanghai physical premium is holding Our recent numbers show Shanghai silver around $81.55, a Western spot near 72. That's roughly a 13-14% premium. During the February crash, that premium briefly reached 29%. With China's 13% VAT, the effective wholesale premium hit nearly 46%. Physical silver in China traded at a 45% premium, while paper prices in New York fell 30%. That tells you one thing: the physical and paper markets are diverging. China has restricted silver exports, limited exports to 44 companies, reclassified silver as a strategic material. Warehouse stocks near decade lows when the world's largest industrial consumer is restricting exports and paying double-digit premiums. That's not a weak market. What it means for long-term stackers. If you're a long-term physical holder, today's price action changes nothing. In fact, it strengthens the thesis. You're watching paper prices fall while physical premiums remain extreme. Silver Eagles, $95 to $165, that's 22% to 110% over spot normal premium. $5 to 8 dealers are backlogged. The U.S. Mint hasn't fully released 2026 Eagles. Major dealers are reporting supply strain. Meanwhile, EFP spreads, $110 per ounce, normal is $25, lease rates, 0.3% to 8% annualized. That's a 16-fold increase. These conditions only occur when physical metal is scarce. The structural deficit silver is now in its 5th consecutive year of structural deficit. And supply can't ramp quickly because in 70% to 80% of silver is a byproduct of other mining industrial demand continues to rise. Solar panels, electric vehicles, 5G, infrastructure, AI, data centers. Over 50% of annual supply goes to industrial use. That demand doesn't stop because futures traders are selling contracts. The technical setup key levels support $72 to $73. Short-term support $69 to $70. Major support $64. Crash low resistance $81 to $82. Near-term resistance $85 to $88. Critical breakout zone moving averages. 50-day $75.65 to 20-day, $93 to $100 day, $49. Long-term bull trend intact. We're currently in a range. The big move comes if we break above $80 or break below 69, the CPI catalyst. The next major catalyst is the January CPI report. Release time, February 138:30 a.m. Eastern expectations, headline 2.5% to 2.6% year-over-year core, 0.3% month-over-month. CPI comes in hot, dollar strengthens, rate cuts get delayed, short-term bearish for silver if CPI comes in soft, rate cut narrative returns dollar, weakens, bullish for metals, the March timeline. We are now 16 days away from February 27th, the first notice day for March deliveries. This is the main event. Normally, 2% to 5% stand for delivery, but recent data shows January deliveries, 49.4 million ounces, 3x higher than 2024. Level 30x historical averages in 1 week, 345 million ounces, withdrawn 26% of inventory in 7 days. Even 25% of March open interest stands for delivery. Demand, 107 million ounces, inventory, 87 to 103 million ounces. There's no margin for error. At higher delivery rates, the system simply can't meet obligations. The bottom line, silver is falling today. It may fall further, depending on CPI, but inventory just fell below 100 million ounces. Drainage continues daily. Delivery rates are near 98%. Physical premiums remain. Extreme institutions are accumulating. These are not opinions. These are numbers, and the numbers say something is coming. The squeeze doesn't happen when everyone is bullish at $121. It happens when sentiment is weak, positioning is light, and supply can't meet demand. March 27 is the trigger window. Either COMEX delivers or the paper market breaks. Friday's CPI is the next catalyst. February 27 is the main event. Stay sharp.